I'm going to help you crack the code and understand where interest rates are going. My name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates. And today we're going to talk about how you can figure out where interest rates are going. It's not a perfect science, but guess what? History repeats itself. That's right. If you go back and look at the data, it can give you a really good indication of where interest rates are going. Now, what do I mean by that? So step one, we've kind of got two data points that we need to bring into the vocabulary here if you're thinking about where interest rates are going, if you're thinking about buying a home. So the first of which is the 10-year treasury. This is basically the benchmark, the standard that a lot of people look at in terms of the overall market. What is the just kind of, I want to throw my money into something for 10 years and get a return and have it backed by the US government. So if things get scary out there, a lot of money rolls into that 10-year treasury. The other data point is the average 30-year fixed, right? So that's always moving as well. And that is dictated by the economy, by mortgage-backed securities, by a whole host of things. I'll link a video right up here to basically how and why interest rates move. It's an illustrated video. It's like 2 minutes. It's a super good reminder of how interest rates move. Now, if you made it this far in the video, I gotta call a quick timeout. I would be forever grateful for that subscribe. Click that bell icon to be notified as I'm putting out weekly videos on the channel. I've got 400 plus subscribers. I'm trying to get to 1,000, so I'd be forever grateful. Now, let's talk about, we've got the 10-year treasury out of the way. Now we're going to talk about the 30-year fixed. So that average 30-year fixed. If you look at the chart, and let me show you the chart here. If you look at the chart, you're going to see that roughly 2% over the 10-year treasury is where the 30-year fixed should be or typically is. So you can go into CNBC, you can go into Google, you can go into wherever you want to go and say, what is the 10-year treasury today? I'm going to use easy math and say the 10-year treasury is 4%. This video is being made January of 2024. Guess what? 10-year treasury, roughly 4%. So if roughly 2% over that number is where the 30-year fix or the 30-year mortgage rate should be, we should be at roughly 6% for our average. And where are we? Well, we're closer to the mid to high sixes according to Freddie Mac. I put a link below to the Freddie Mac weekly survey. It's a survey across all lenders across the country that are delivering loans to Fannie Mae. It's a great, Freddie Mac, and it's a great indication of where interest rates are at. So with that said, that link is below. With that said, right now we're seeing a 2.5%, and we've even seen a 3% difference. That's a huge delta. That's a huge difference between those two numbers. That is not normal. That's why right now in January 24, we'll likely see interest rates going down. You could be looking at that video in 2025, or you could go back and look and say, where were rates in 2022, or where were rates in 2018 for that matter. Now, COVID from 20 and 21 was incredibly weird, from what the Fed did to putting money in people's pockets when we had short supply on just about everything, which caused this massive amount of inflation. I don't want to get on a soapbox. I could talk for hours on this. With that said, that was a weird time. Our normal difference between those two should be roughly 2%. So we're going to likely see in 2024, I'm projecting rates will be lower, just pure and simple because we are normalizing. Inflation's coming down. Again, if you're watching this video in the future and you look where that 30-year fixed is at and you look where that 10-year treasury is at, that should give you a good indication of how normalized this market is. And you can go back decades and decades and decades to be able to see this number. Now I'm going to bring up a couple more charts here, and you're going to be able to see that 10-year and that 30-year following each other very, very closely. This next chart, I've got the highlighted area, and this is showing you that we got to that cap of basically 3% difference between the 10-year and the 30-year. That, again, is a massive amount. So my hypothesis, looking at 2024, we're going to see lower rates because we're going to see a more normalized market. I could also see rates, and I mentioned this before in videos, that we're going to start to see a very short inventory, which is something that is not new, and we're going to see buyers coming back into the market. If we get to say 5.875, holy cow, we're going to blow the barn doors off. There's going to be people coming in. It's just one of those. I'm a golfer, so there's an old set of golf clubs here. The difference between shooting 79 and 80 is like a lifetime of the game. I mean, those of you that might play golf, comment below. It might be one stroke different, but it is drastic in terms of, yeah, I shot 79, not bad, right? Versus, I shot 80, for the good players at least, right? So there's a big difference. If we get below that 5.875, I believe we're going to see a ton of buyer demand. That's going to also help push rates down because there's going to be lenders that are going to be trying to steal market share from one to the other and trying to put all these new purchases in. So I'd love to hear your comments below. Do you think that could happen? Do you think we could see rates at that 5.875 in the next 90 days, in the next 6 months? Have you ever been told, hey, there's a 2% difference between the 10-year and the 30-year? So go back and look if you're ever curious of when you bought. I'd love to hear what that difference was, if you can just look at it really quick. And again, if you're thinking about buying a home in 2024 and you've got questions, put those below. I'd be forever grateful. So thank you so much. Looking forward to the discussion down in the comments section. If you made it this far, click that subscribe. Stay safe, and we'll see each other again very, very soon.